Hello, and welcome to the Beginner to Advanced Trading course. Trading is more than just numbers on a screen or charts on a graph. It's a journey, a pathway paved with dedication, discipline, and perseverance. Whether you're here to start your trading journey or refine your skills, this course is designed to empower you with the tools, strategies, and mindset needed to trade successfully in any market. In this course, we'll cover everything from foundational trading concepts to advanced strategies that professionals use. But before we dive into the details, let me share an important truth. Trading is not about luck. It's about preparation, consistency, and a willingness to learn from every success and setback. So, let's take this first step together. Grab your notepad, stay focused, and commit to mastering the art and science of trading. Important disclaimer. Before we proceed, it's crucial to understand the nature of the information provided in this course. The content you'll encounter is designed solely for educational purposes. It should not be interpreted as personalized legal, tax, financial, or investment advice. Since every individual's circumstances are unique, consulting a qualified professional is essential before making any financial decisions. Trading, particularly on margin, carries significant risks and may not be suitable for all investors. The leverage involved can amplify gains but also magnify losses. Carefully assess your investment objectives, experience level, and risk tolerance before engaging in any trading activity. This course is not intended for certification purposes, nor will it qualify you for any industry licenses or employment opportunities. Past performance examples are not indicative of future results. Investing always carries the possibility of loss, including losses that exceed your initial investment. Therefore, consider seeking guidance from an independent financial advisor if you have any doubts or concerns. Lastly, any opinions, analyses, or information shared here do not constitute investment advice. We accept no liability for any loss, including but not limited to financial losses, arising from the use or reliance on the information provided in this course. Understanding these points is vital as we embark on this educational journey together. Main focuses of the course. Now that we've covered the essentials of this course, let's dive into what you can expect to learn and focus on throughout our journey together. Whether you're a complete beginner or a trader with some experience, this course is designed with you in mind. 1. For all levels of traders. This course is here to help traders of any experience level. Whether you're just starting out or looking to refine your skills, we'll work together to build the knowledge and systematic approach you need to become consistent in your trading performance. 2. Tools and personalization. You'll gain access to a wide range of tools, allowing you to choose the strategies that best align with your personality, schedule, and unique trading style. Flexibility is key, and this course will empower you to adapt your approach to what works best for you. 3. Simplifying the start for beginners. For those new to trading, we'll start with the basics. I'll guide you step by step through understanding markets and reading charts, ensuring you have a smooth and confident start in your trading journey. 4. Risk and money management. We'll explore the critical concepts behind risk and money management. You'll learn why these are the foundation of successful trading and how to implement them effectively to protect your capital. 5. Trading psychology. Trading isn't just about numbers. It's about mindset. We'll delve into the psychology behind trading, helping you stay focused, manage emotions, and avoid difficult situations that can arise in the markets. 6. Price action and technical analysis. You'll gain a solid understanding of price action and technical analysis concepts. These are the tools that will allow you to read the markets and make informed decisions. 7. Mechanical strategy development. I'll teach you how to build an effective mechanical strategy, step by step. This will give you a systematic approach to trading that removes guesswork and brings consistency to your decisions. 8. Building a trading plan. Next, you'll learn how to design a robust trading plan that supports consistency and enhances your overall performance as a trader. 9. Journaling and continuous improvement. We'll also talk about the importance of keeping a trading journal. This practice will help you analyze your trades, learn from your experiences, and improve week by week. 10. Continuous development. It's important to understand that trading is a journey. No matter how experienced you are, there's always room to grow. This course will encourage you to continually develop your skills, strategies, and plans to stay effective and keep growing your portfolio. 11. Next steps after completion. Finally, I'll guide you on what to do after you complete this course. You'll have a clear roadmap to keep learning, improving, and working towards achieving your trading goals. These focuses form the backbone of this course, and they are designed to help you become the trader you aspire to be. So let's get started and take the first step toward trading success. How to make the most out of this course. To get the best results from this course, it's important to approach it in a way that maximizes your learning and helps you apply what you've learned effectively. Start by watching each video and going through every topic carefully. Take notes as you progress, write down key points, observations, and, most importantly, any questions that come to mind. If your question isn't answered by the end of the video, don't hesitate to post it in the comment section. I'll make sure to answer as soon as possible. For technical analysis, practice each concept individually at least 10 times. This repetition will help you develop the skills needed and truly understand how to apply them effectively in real-world scenarios. Once you've practiced all the concepts, start backtesting your strategy. Backtesting is one of the most critical exercises for mastering trading. Combine this with demo trading to test and refine your skills. The more you practice, the more confident and competent you'll become. If you already have some experience and are familiar with concepts like markets, pips, and price action, you can skip directly to the sections on technical analysis and price action analysis. However, reviewing the fundamentals could still provide valuable insights and serve as a refresher. If you're completely new to trading, I recommend starting with the introductory sections. These provide a concise summary of essential concepts in trading, markets, and technical analysis that every trader needs to know. Take your time with these sections and take thorough notes to build a strong foundation. Remember, trading is a skill that takes time and dedication. Approach this course with focus and discipline, and make the most of the resources and opportunities for practice. Let's get started. Hello. Introduction to Trading and Price Action. A vital foundation for anyone looking to understand the markets. Whether you're a beginner or someone with some experience, this is the perfect starting point for you. When analyzing the markets, there are various types of charts traders use: line charts, bar charts, and Japanese candlestick charts, among others. Each has its own unique strengths and purposes. However, in this course, we're going to focus on candlestick charts. Why? Because candlestick charts offer the clearest and most detailed representation of price movement within any given time frame. By understanding candlestick charts, you can better visualize and analyze the market's behavior. These charts allow traders to interpret price action and make more informed decisions, whether you're trading stocks, forex, or crypto. Now that you know why candlestick charts are the go-to tool for traders, you're ready to dive deeper into the world of price action. The line chart is one of the simplest types of charts used in trading. It is drawn by connecting the closing prices of a market within a determined time frame. This creates a clear and straightforward representation of price trends over time. The bar chart. Represented by individual bars, and each bar tells us the open, close, high, and low prices of an asset within a determined time frame. These charts provide a better representation of price action, allowing traders to analyze the market's movements more effectively. The candlestick chart. Similar to a bar chart, as it also tells us the open, close, high, and low prices of an asset. However, it is represented in a way that is much more visually intuitive, making it easier for us to analyze the markets clearly. That's the main reason we will primarily focus on candlestick charts in our analysis. There are other types of charts available, but our main focus will be on candlestick charts. This is because they provide a clearer picture of price action, allowing for better analysis and more informed trading decisions. Candlesticks. As pointed on the slide, they display the open, high, low, and close. They are particularly useful for price action analysis, as they allow us to see the price movement and order flow more clearly. Each candlestick provides a snapshot of the price activity within a specific time period, with the open showing where the price started, the high marking the highest point reached, the low representing the lowest point, and the close indicating where the price ended. By using candlesticks, traders can better interpret market behavior, as the structure of candlesticks reveals trends, reversals, and the strength of price movements. In short, candlesticks give us a clearer view of how price is moving and provide insights into the buying and selling activity driving the market. With candlestick charts, we can look at a chart and recognize different types of patterns throughout the chart that can help us make specific trading decisions. These patterns can range from individual candlestick formations to more complex patterns, and they provide valuable insights into market sentiment and potential price movements. Candlestick patterns can also highlight specific formations or support and resistance zones or levels, allowing traders to identify key areas where price may reverse or continue its trend. Depending on the trader's strategy, these patterns and levels can be used to make informed decisions on entry and exit points. Pips are only used for when the price is decimally exchanged. Mostly used in currency pairs because their movements are done by pips. Specifically, the fourth decimal number. Majority of other asset classes that we can trade on the markets is traded by the minimum value of cents. This is just to have a quick illustration of how price moves up and down, depending on the marker that you are looking at. As stated by Mark Douglas, if you can learn to create a state of mind that is not affected by the market's behavior, the struggle will cease to exist. Markets. There are different types of markets that you can trade to make a profit. However, each market comes with its own set of pros and cons, so understanding these differences is key to choosing the right one for your trading strategy. Forex. Short for foreign exchange, is the market where one currency is exchanged for another. It's the largest financial market in the world, operating 24/7, and plays a vital role in global trade and investment. Pros and cons. Let's look at some of the pros of trading in the Forex market. First, liquidity. The Forex market has a massive daily turnover of over $5 trillion, making it the most liquid market in the world. This means you can easily enter and exit trades without significant price changes. Next, it's a 24/5 market. Forex is open from Sunday at 10 p.m. GMT to Friday at 10 p.m. GMT, allowing you to trade at almost any time during the week, no matter your time zone. Finally, there's leverage. Leverage lets you trade with more capital than you have in your portfolio. While this can amplify profits, it can also increase losses, so it's a double-edged sword. How you use leverage is critical to your success. Now let's take a look at some of the cons of trading in the Forex market. First, counterparty risks. Since retail traders must rely on third-party online brokers to make transactions, there's a risk that some brokers may not have their clients' best interests in mind. Unscrupulous brokers might fail to honor contracts or manipulate spreads to tag you out of trades. This is why choosing a fully regulated broker is crucial. Next, leverage risk. While leverage can amplify profits, it can also magnify losses. If you have a solid risk and money management plan and stick to it, leverage can be a helpful tool. However, without proper management and by trading randomly, there's a high probability of losing your entire portfolio. Lastly, operational risk. Forex markets are highly volatile and operate 24/5, which makes them challenging to manage manually. Humans can't monitor markets around the clock, which is why having a well-thought-out trading plan is essential. A good plan helps minimize the impact of volatility, especially when prices move against your original trade entry. Commodities. A commodity is any physical object that can be bought and sold, such as gold, oil, or agricultural products. Commodity trading generally involves buying and selling these goods to profit from the price margins created by market fluctuations. Let's explore key pros of trading commodities. Protection against inflation. As the demand for goods and services increases, the cost of raw materials, commodities, also rises. This leads to higher prices for the finished goods. In inflationary periods, interest rates tend to rise, increasing borrowing costs and reducing company profits. Consequently, stock prices often fall during these times. However, commodities behave differently. Their prices usually rise due to the growing demand for raw materials. This makes commodity futures an attractive option for investors looking to protect their capital. By investing in commodities, they can maintain the value of their portfolios and shield themselves from the negative effects of inflation. Another significant advantage of trading commodities is their role as a hedge against risky geopolitical events. Geopolitical events like conflicts, riots, and wars often disrupt supply chains, making it difficult to procure and transport raw materials to factories. This scarcity of resources causes a mismatch between supply and demand, leading to a sharp rise in commodity prices. During such events, pessimism often grips the financial markets, causing stock prices to plummet. By investing in commodities during these times, traders can offset losses in their portfolios and even profit from the rising prices of scarce resources. High leverage facility. Commodity derivatives, such as futures and options, offer an exceptionally high degree of leverage. With just 5 to 10% of the contract value as an upfront margin, you can control a large position. Even a small movement in commodity prices can result in significant gains, creating the potential for exponential returns. However, it's important to note that leverage is a double-edged sword. It can amplify profits, but it can also magnify losses if the trade goes against you. Diversification. Commodities have a low or even negative correlation with stocks. As raw materials essential for manufacturing, rising commodity prices increase production costs. This reduces company profits, leaving less for shareholders and lowering earnings per share. Ultimately, this can lead to a decline in stock prices. Unlike stocks or bonds, commodities respond directly to fundamental factors like weather conditions, strikes, or geopolitical instability, which influence their supply and demand. Since their price movements are largely independent of stock market trends, commodities offer a unique opportunity to diversify your portfolio. This negative or low correlation with stocks makes commodities an attractive investment for those seeking to balance risk and returns. Transparency. In the past, commodities were traded using the outcry system, which lacked accessibility and efficiency. Today, trades are conducted on electronic trading platforms, accessible to all market participants. These platforms enable fair price discovery through broad-scale participation, driven solely by supply and demand. This eliminates the risk of manipulation, as there is no direct intervention from buyers or sellers. Prices are determined when the quantity and price quoted by both parties match perfectly, ensuring a transparent and reliable trading process. Additionally, like the Forex market, the commodity market operates 24/5, giving traders the flexibility to trade at almost any time during the week. Cons. Leverage, which can be a double-edged sword, allows you to control a large position with minimal upfront capital. For example, if the initial margin requirement is just 5%, you could control a commodity futures contract worth $100,000 with only $5,000. While this can amplify your profits, it also magnifies your losses. A small price drop, say 10 pips, could result in a $10,000 loss, assuming a lot size of 101,000 contracts purchased. Additionally, the low margin requirements in commodity trading can encourage excessive risk-taking, which could potentially wipe out your entire investment if not managed properly. Volatility. Why commodity prices are so unpredictable. If you've ever noticed how the cost of oil, food, or metal swings wildly, you've witnessed volatility in action. The main reason? Commodity prices depend heavily on supply and demand, and here's the catch: they're both price inelastic. Price inelasticity means that even when prices rise or fall, the amount of supply doesn't change quickly. Why? Because increasing production takes time. Think about it: if the price of wheat doubles, farmers can't instantly grow more. Crops need to be planted, grown, and harvested, which takes months. It's the same for natural gas or metals. Mining and extracting take a lot of time and effort. Now, let's talk about demand. Commodities are essential to daily life: food, fuel, and raw materials for construction. Even if prices go up, people don't stop needing them. Can you really stop eating bread or fueling your car? Not really. That's why demand for these goods doesn't drop much even when prices rise. Here's where things get interesting. Because both supply and demand are inelastic, even small disruptions in the market can cause huge price swings. For example, a natural disaster like a drought or hurricane can reduce supply, but demand stays the same. The result? Prices spike dramatically. On the flip side, if demand drops suddenly, like during a global slowdown, prices can crash because supply can't adjust fast enough. This sluggish response to changes in supply and demand is why commodities are so volatile. They're highly sensitive to shocks like weather, politics, or even global events. For investors, understanding this dynamic is crucial. Knowing how supply and demand interact and how inelasticity plays a role can help you spot opportunities and risks in the market. Let's dive into stocks. In finance, a stock represents ownership in a company. Think of it as a slice of the pie. A single share of stock is a fraction of the entire company. The more shares you own, the larger your ownership stake becomes, but it's always proportional to the total number of shares the company has issued. So, when you buy a share, you're not just investing in a piece of paper. You're owning a small part of the business itself, with the potential to benefit from its success, and, of course, to share in the risk if things don't go as planned. Let's talk about the pros of investing in stocks. First up, taking advantage of a growing economy. As the economy expands, so do corporate earnings. More jobs mean more income, which means more consumer spending. When people have bigger paychecks, they spend more, and that boosts company revenues. If you understand the different phases of the business cycle, expansion, peak, contraction, and trough, you'll see how stocks can thrive in the right phase of economic growth. Next, stocks are a great way to stay ahead of inflation. Over time, stocks have historically provided an average annual return of about 10%. That's better than the average inflation rate. Of course, to benefit from this, you need to have a longer time horizon, allowing you to hold onto your stocks even during temporary dips in value. And finally, stocks are easy to buy. The stock market has made it incredibly simple for investors. Whether you're using a broker, financial planner, or buying online. Once you have an account set up, you can buy stocks in just a few minutes. It's a quick, straightforward process to get started on your investment journey. With stocks, you can make money in two main ways. The first is buying low and selling high, something every investor aims for. You invest in companies that are growing quickly, hoping their value will rise over time. This strategy works for both day traders who buy and sell quickly, as well as buy and hold investors who are in it for the long term. Another advantage is that stocks are easy to sell. The stock market gives you the ability to sell your shares at any time, which is a huge plus. Economists call this liquidity, meaning you can turn your stocks into cash quickly and with low transaction costs. This flexibility is important if you ever find yourself needing the money fast. However, there's a catch. Because stock prices can be volatile, you might end up selling at a loss if you're forced to liquidate quickly. Now, let's talk about the cons of investing in stocks. First and foremost is risk. You could lose your entire investment. If a company performs poorly, investors might sell their shares, causing the stock price to drop. If you sell at that point, you'll lose the money you initially put in. This is why it's critical not to invest money you can't afford to lose. On the bright side, there's a small silver lining: you can get an income tax break if you lose money on a stock. But if you make money, don't forget you'll need to pay capital gains taxes. Next, there's the issue of stockholders getting paid last. If a company goes bankrupt, bondholders and preferred stockholders are first in line to get paid, leaving regular stockholders at the bottom of the list. While bankruptcy isn't common, this is where having a diversified portfolio becomes a lifesaver. By spreading your investments across multiple companies and industries, you'll reduce the risk of losing it all. Next, there's time. Investing in stocks requires effort. If you're managing your investments yourself, you'll need to research each company, analyze their financial statements, and stay up to date on their news and performance. On top of that, you'll have to keep an eye on the broader stock market. Even the best companies' stock can drop during market corrections, crashes, or bear markets, so staying informed is essential. Another downside to investing in stocks is the emotional roller coaster. Stock prices rise and fall literally every second, and it's easy to let emotions take over. Many investors fall into the trap of buying high because of greed and selling low out of fear. That's a surefire way to lose money. The best approach? Don't obsessively watch stock prices all day, it's exhausting and unproductive. Instead, check in on a regular schedule. This is why we rely on price action analysis to guide our decisions. It helps us stay objective and know when it's the right time to buy or sell. Then there's the challenge of professional competition. Let's face it, institutional investors and professional traders have the upper hand. They've got the time, resources, and expertise to analyze markets. On top of that, they have access to sophisticated tools, financial models, and powerful computer systems. But here's the thing: while it's not easy to make money in stocks, it is possible. If big institutions, banks, and traders are doing it, that means it can be done. It's just not as effortless as social media might make it seem. Success takes time, strategy, and discipline, but with the right approach, you can compete and carve out your own path in the market. In short, stocks can offer great rewards, but they require careful planning, patience, and a tolerance for risk. Bonds are another key concept in finance. Simply put, a bond is a type of security where the issuer owes you, the bondholder, a debt. It's like giving someone a loan, but in this case, it's a government, corporation, or organization borrowing money from you. Here's how it works: when you buy a bond, you're essentially lending money to the issuer. In return, they promise to pay you back the principal amount, the money you lent, on a specific maturity date. Plus, over the course of the bond's term, they'll pay you interest at regular intervals. This steady flow of interest payments, combined with the return of your initial investment at maturity, is what makes bonds a popular choice for investors looking for stability and predictable income. Let's take a look at the pros of investing in bonds. First, investment returns are fixed. With bonds, you receive a fixed rate of interest over the bond's term, and your principal, the original amount you invested, is returned when the bond matures. This predictability makes bonds an excellent option if you like knowing exactly how much you'll earn. Second, bonds are less risky compared to stocks. Not only do you receive guaranteed interest payments, but bondholders are also prioritized over shareholders if the issuer faces liquidation. That means you're more likely to get your money back in the event of financial trouble. Third, bonds are less volatile than stocks. While their value can shift based on changes in interest rates and inflation, these fluctuations are usually much smaller than the swings seen in the stock market. This stability makes bonds a safer, more predictable investment for risk-averse individuals. Lastly, they have clear ratings. Unlike stocks, bonds are rated by trusted credit rating agencies like Standard & Poor's and Moody's. These ratings give you an idea of how risky or safe a bond is, making it easier to make informed decisions. However, while these ratings provide a solid starting point, it's always a good idea to do your own research and due diligence before investing. Relying solely on ratings might not give you the full picture. Now, let's look at the cons of investing in bonds. First, investment returns are fixed. While this provides safety and predictability, it also means you're missing out on the potentially higher gains you could earn by investing in stocks. Bonds prioritize stability, but that comes at the cost of growth potential. Second, bonds can require a larger sum of investment. While some bonds are affordable, starting around $1,000, others may require a much larger upfront investment, making them less accessible for some investors. Next, bonds are less liquid compared to stocks. While bonds issued by the U.S. Treasury or major corporations are easy to buy or sell, smaller or less stable companies' bonds may have fewer buyers, making them harder to trade. Bonds with very high face values can also struggle with liquidity since fewer investors can afford them. Finally, bonds come with direct exposure to interest rate risk. When interest rates rise, the value of existing bonds typically falls because new bonds are issued with higher returns, making older bonds less attractive. If you're planning to hold the bond until maturity, this might not matter, but for those looking to sell before then, this can pose a significant risk. Let's talk about cryptocurrency, or simply crypto. In computer science, cryptocurrency is a form of digital currency that operates without relying on any central authority, like a bank or government, to manage or maintain it. Instead, cryptocurrencies use distributed ledger technology, most commonly a blockchain, to securely store transaction and ownership data. This decentralized approach ensures transparency and security while eliminating the need for a middleman. It's what makes crypto so unique in the world of finance. Let's dive into the pros of cryptocurrency. First, there's no fraud or scams in cryptocurrency transactions. Unlike traditional payment methods like online banking or credit cards, crypto payments cannot be reversed or declined. Once a payment is made, it's final and reaches the recipient within seconds. Additionally, since cryptocurrency operates on secure digital systems like blockchain, it's nearly impossible to manipulate or tamper with transactions. Another major advantage is no chance of personal information leakage. When you pay with a credit card, for example, you often need to share sensitive details like your PIN, which can be risky. With cryptocurrency, that's not an issue. You never have to share your private key with anyone. All transactions are 100% encrypted, ensuring your payment details remain private and secure. For those who value anonymity, cryptocurrency is an excellent choice. Another big advantage of cryptocurrency is the ability for immediate and secure ownership transfer. If you hold cryptocurrency in your digital wallet, you've got a valuable asset that you can transfer to anyone instantly, without needing approvals or middlemen. All you need is the recipient's private key, and the transaction is complete with no fees, no lengthy paperwork, and no complications. This stands in stark contrast to traditional transfers, like property ownership changes or closing a bank account, which often involve tons of documentation and commission fees. With cryptocurrency, the process is seamless and hassle-free. Now let's take a look at the cons of cryptocurrency. First, illegal activities can be facilitated. Cryptocurrencies are sometimes used for illicit payments or activities on the internet because of their anonymity and lack of regulation. Unfortunately, no government can completely ban cryptocurrency since no single entity has authority over it. While restrictions can be applied, banning it outright is nearly impossible due to its decentralized nature. Second, there's a high risk of loss. The lack of ownership and authority over cryptocurrency comes with its own set of risks. If you make a mistake or encounter a technical error in your wallet, there's no one to turn to for help or compensation. There's no company or institution overseeing cryptocurrency, so you can't make claims or file reports if something goes wrong. To minimize these risks, choose a trusted wallet with strong reviews and ensure you understand your country's current cryptocurrency policies before diving in. Managing these risks requires preparation and vigilance. Another major drawback is that the cryptocurrency market is highly volatile. The value of cryptocurrencies can change drastically in a short period, making it extremely difficult to predict price movements. To navigate this, you need to be a skilled analyst and researcher, staying constantly updated on market news and trends. Investing in cryptocurrency requires you to be prepared for sudden fluctuations, both gains and losses. If you're considering investing in crypto, make sure you're ready to handle the uncertainty that comes with this highly dynamic market. What does trading mean? At its core, trading is an economic activity that involves buying and selling goods or services. These can be material things, like cars or food, or non-material assets like services, businesses, or even digital currencies and securities that you can buy online without physically owning them. International trade, in particular, opens up opportunities for countries to access goods and services they wouldn't have otherwise, expanding markets and driving economic growth. In financial markets, trading specifically refers to the buying and selling of securities such as stocks, currencies, cryptocurrencies, bonds, and more. As traders and investors, our primary goal is to profit from the swings these markets experience. We aim to buy low and sell high, a simple concept but not always easy to execute. Success in trading requires discipline, dedication, and a lot of effort. It's not an overnight journey, but with the right focus and consistent practice, we can achieve steady and reliable earnings. While the road to becoming a skilled trader isn't easy, the rewards, both financially and personally, are absolutely worth it. Here's a powerful quote from the legendary investor Warren Buffett. "If you don't find a way to make money while you sleep, you will work until you die." This simple yet profound statement highlights the importance of passive income and smart investing. It's a reminder that relying solely on active income, where you trade time for money, can limit your financial growth. Investing in assets like stocks, real estate, or businesses that generate income while you're not actively working is the key to long-term financial freedom. The earlier you start building these streams, the closer you get to breaking free from the cycle of working just to make ends meet. What is best suitable for you? Trading strategies aren't one size fits all. They depend on your availability, time zones, and most importantly, how you view and interact with the market. Each trader has a unique personality, and the strategy that works best will align with their individual style and schedule. For example, I'm a price action analyst. I focus on identifying patterns and building confluences around key price levels to create setups with the highest probability of success. This approach suits my style because it's based on observing raw market movements without relying heavily on external tools. Others might prefer an indicator-based strategy, using technical indicators to guide their analysis and create setups. This approach works great for those who feel more confident using tools like moving averages, RSI, or MACD. Some traders thrive with support and resistance levels, where they focus on price zones where the market historically reacts. For them, these levels act as a roadmap for entering or exiting trades. Ultimately, the key is to find what aligns with your personality and how you perceive the market. Experiment, explore, and refine until you discover the strategy that works best for you. Throughout my trading journey, I've explored various strategies and methodologies, but what truly resonates with me is focusing on price action patterns and levels. This approach aligns perfectly with my understanding of the market and equips me with logical concepts that help me forecast market movements more effectively. By understanding the underlying market dynamics, I can spot recurring patterns and seize opportunities to capitalize on potential market shifts. A key part of my routine is journaling. This isn't just about keeping a record of trades, it's a tool for continuous improvement. Journaling allows me to reflect on my trades, analyze patterns, and refine my strategies. By documenting my experiences meticulously, I can pinpoint areas for growth, avoid repeating mistakes, and evolve as a trader with every passing day. In essence, my approach to trading centers on leveraging price action patterns, maintaining a diligent journaling practice, and strategically choosing my trading times. By sticking to these principles, I aim to enhance my performance, achieve consistency, and navigate the dynamic financial markets with confidence. Technical analysis. Technical analysis is all about using technical tools to analyze an asset and identify trading opportunities. This can involve indicators, price action, support and resistance, price patterns, candlestick patterns, and more. Essentially, it's the art of evaluating price charts to make informed trading decisions. The core belief behind technical analysis is that past market behavior can help predict future movements. By studying historical price data and patterns, traders aim to anticipate market reactions and capitalize on potential opportunities. Mastering technical analysis requires practice, patience, and a deep understanding of market dynamics, but once developed, it becomes a powerful tool for making strategic trades. Risk and money management and why it's important. Capital management is one of the most important aspects of becoming a successful trader. The reason is simple: if you don't manage your capital properly, the market will take it away from you very quickly. As traders, our main goal isn't just to make a few profitable trades, it's to gradually and consistently grow our portfolio over time. Proper risk management ensures that even in a losing streak, we protect our capital and stay in the game long enough to capitalize on winning opportunities. Without a solid capital management plan, even the best strategy won't help in the long run. That's why mastering this skill is essential for long-term success in trading. As a general rule, we should never risk more than 1% of our capital per trade. The reason is simple. The markets are unpredictable and difficult to trade, so we should never put our entire portfolio at risk on a single trade. By sticking to this rule, we protect our capital and give ourselves enough opportunities to recover from small losses. Even if we face a losing streak, our portfolio remains intact, allowing us to keep trading and improve our strategy. This approach works even better when combined with good risk-reward ratios, but we'll dive deeper into that later. Another crucial reason to only risk 1% per trade is the psychological impact of losing money. The more we lose, the more emotionally attached we become, which often leads to poor decision-making. For example, if you lose 25% of your capital, frustration can set in, leading to overtrading in an attempt to recover losses quickly. On the flip side, fear might take over, causing hesitation and missed opportunities on profitable trades. As you gain experience in trading, these concepts will become even clearer. That's why, if you're just starting out, I strongly recommend opening a demo account with any broker. This will allow you to practice in real market conditions without risking real money. You'll quickly realize that trading isn't easy, and because of that, we must protect our capital and focus on slow, steady growth over time. Effective money management is a key pillar of successful trading, and setting clear risk limits is essential. A good rule of thumb is to limit risk to 5% per week and 15% per month. But what does this actually mean? Let's break it down. If you lose 5% of your capital within just 2 days, it's wise to step back and take a break for the rest of the week. Use this time to review your trades, analyze mistakes, and adjust your strategy. Keeping a trading journal during this downtime helps you spot patterns in your decision-making and refine your approach. If you experience 3 consecutive losing weeks, it's time to pause for the rest of the month. This gives you the chance to reassess, learn from your mistakes, and return with a clearer mindset. By following these principles, we protect our capital, develop better trading discipline, and improve over time. Taking a step back when needed isn't quitting, it's a strategic move that ensures long-term success in the markets. In addition to risk management, another key concept every trader must understand is drawdowns. What are drawdowns? Simply put, drawdowns refer to losing streaks that cause a significant decline in capital, typically ranging from 10 to 20% or more. They act as warning signs that market conditions may not be in our favor or that our strategy needs adjustments. Turning drawdowns into learning opportunities. Instead of seeing drawdowns as setbacks, we should use them as opportunities to improve. By analyzing our trades during losing periods, we can identify mistakes we may be making, assess whether market conditions have changed, determine if we need to adjust our strategy or just remain patient. When should you take a break? One way to know when to step back and review is by backtesting our strategy and analyzing past performance to set realistic drawdown limits. If we exceed these limits, it's a clear signal to pause, reflect, and adjust before continuing to trade. By understanding drawdowns and incorporating self-review into our routine, we develop stronger resilience and a better ability to navigate the ever-changing financial markets. Risk-reward and win rate ratio. The risk-reward ratio, R to R, is a fundamental concept in trading that helps evaluate the potential profit versus the potential loss of a trade. How is the risk-reward ratio calculated? If you risk 1% of your capital per trade, your potential profit could be 1 to 1, risking 1% to gain 1%. 1 to 2, risking 1% to gain 2%. 1 to 3, risking 1% to gain 3%. 1 to 4, risking 1% to gain 4%. In trading, it's common to express this as R, where a 7% gain on a 1% risk trade is referred to as 7R trade. Why is R to R important? Helps traders evaluate if a trade is worth taking. Ensures risk is controlled relative to potential reward. Helps build consistent profitability over time. By mastering risk-reward ratios, traders can make informed decisions and maximize profitability while minimizing losses. The relationship between the risk-reward ratio and win rate is one of the most crucial concepts in trading. Understanding how these two factors interact can help traders develop a sustainable, long-term strategy that maximizes profitability while minimizing unnecessary risk. Let's start with the basics. The win rate is the percentage of trades that result in a profit. If a trader has a 50% win rate, it means they win half of their trades and lose the other half. But does that automatically mean they'll break even? Not necessarily. That depends on the risk-reward ratio. A risk-reward ratio of 1 to 1 means that for every dollar risked, the potential gain is also $1. In this scenario, assuming equal position sizes and a 50% win rate, a trader would break even over time. While this might seem reasonable, it doesn't provide a significant edge in the market. Now, let's adjust that ratio. If the risk-reward ratio increases to 2-to-1, meaning for every dollar risked, the potential return is $2, the dynamics change. Even with the same 50% win rate, the winning trades are now twice the size of the losing ones. This creates a significant advantage, as profits accumulate faster than losses, leading to a net positive outcome over time. This principle is what sets profitable traders apart. Success in trading isn't just about how often you win, it's about how much you make when you win versus how much you lose when you're wrong. A strong risk-reward ratio provides an edge, ensuring that even a moderate win rate can still lead to consistent profitability. As we progress, we'll explore deeper applications of this concept, including how to structure trades effectively and how to refine risk-reward strategies to fit different market conditions. But for now, the key takeaway is this. A high win rate is not enough, but how much you gain per trade relative to how much you risk is what truly matters. Indicators. Indicators are essential tools in technical analysis, designed to assist traders in making informed decisions by analyzing historical price data. These tools provide directional bias or trading signals, helping traders identify potential market trends, reversals, and momentum shifts. However, the effectiveness of indicators depends entirely on how they are applied. Some traders use indicators as their primary decision-making tool, while others use them as confirmation tools alongside price action and market structure. The key is understanding how these indicators work and integrating them into a strategy that aligns with your trading style and market perspective. Indicators are not foolproof, and no single indicator works in all market conditions. That's why successful traders focus on using them in confluence with other factors, such as support and resistance levels, price patterns, and fundamental analysis. In the next sections, we'll explore different types of indicators, their applications, and how to use them effectively to enhance trading accuracy and consistency. One of the most widely used technical indicators in trading is the moving average, MA, and its variation, the exponential moving average, EMA. These indicators help traders analyze price trends by smoothing out fluctuations and providing a clearer picture of market direction. A moving average is simply the average closing price of an asset over a specified period. It acts as a lagging indicator, meaning it follows price trends rather than predicting them. The exponential moving average, on the other hand, gives more weight to recent price data, making it more responsive to price changes compared to a simple moving average. How do traders use moving averages? Directional bias. Traders use moving averages to determine the overall trend. If the price is consistently above the MA, the trend is considered bullish. Then, if below, the trend is bearish. Dynamic support and resistance. Moving averages can act as floating support and resistance levels. When price retraces to an MA and bounces off, it may signal a continuation of the trend. Crossovers. A shorter-term MA crossing above a longer-term MA, for example, the 50 EMA crossing above the 200 EMA, can signal a potential buy opportunity, while the opposite signals a possible sell opportunity. The effectiveness of moving averages depends on how they fit within a trader's overall strategy. Some traders rely heavily on them, while others use them as a secondary confirmation tool. The key is to test and refine their application based on market conditions and personal trading style. MACD, Moving Average Convergence Divergence. The MACD is a trend-following momentum indicator that helps traders analyze price movements and identify potential trade opportunities. It works by comparing two moving averages to measure momentum shifts. How MACD works? MACD consists of three key components. The MACD line represents the difference between the 12-period EMA and the 26-period EMA. The signal line, the 9-period EMA of the MACD line, is used to generate trade signals. The histogram represents the difference between the MACD line and the signal line, visually indicating momentum strength. How traders use MACD. Crossovers. When the MACD line crosses above the signal line, it suggests a bullish trend, a buy signal. When the MACD line crosses below the signal line, it indicates a bearish trend, a sell signal. Histogram interpretation. A growing histogram suggests increasing momentum in the trend direction. A shrinking histogram signals weakening momentum, potentially indicating a reversal. Divergences. In bearish divergence, the price makes new highs, but MACD forms lower highs, with a possible downtrend ahead. In bullish divergence, the price makes new lows, but MACD forms higher lows, with a potential uptrend signal. MACD is a powerful tool when combined with other indicators and market analysis. It helps traders confirm trends and make informed decisions, but like any indicator, it should not be used in isolation. The Relative Strength Index, RSI, is a momentum indicator that measures the speed and magnitude of recent price movements to assess whether an asset is overbought or oversold. It ranges from 0 to 100, helping traders identify potential reversal points in the market. How RSI works. Overbought. When the RSI is above the 70% mark, the asset may be overbought, indicating a potential for a price correction or reversal downward. Oversold. When the RSI is below the 30% mark, the asset may be oversold, suggesting a possible price rebound or upward movement. How do traders use RSI? On trend confirmation, the RSI can help confirm the strength of a trend. In an uptrend, RSI tends to stay above 40, while in a downtrend, it remains below 60. Divergences. In a bullish divergence, the price makes a new low, but RSI forms a higher low, with a potential upward reversal. In a bearish divergence, the price makes a new high, but RSI forms a lower high, with a possible downward reversal. On a swing trading strategy, traders look for overbought or oversold levels to time their entries and exits. While RSI is a valuable tool for spotting potential reversals, it works best when combined with other technical indicators and price action analysis to improve accuracy. Bollinger Bands. They are a simple yet powerful tool used to gauge market volatility and identify potential trade opportunities. They consist of 3 lines. The middle band, which is just a simple moving average or SMA. The upper band, which is the SMA plus a standard deviation. The lower band, which is the SMA minus a standard deviation. How traders use them. When the price touches the upper band, it's often considered overbought, meaning a pullback or reversal could be coming. When the price touches the lower band, it's seen as oversold, signaling a potential bounce. If the bands start expanding, it means volatility is increasing and the markets are heating up. If the bands contract, it signals low volatility, which could mean a big move is coming. A common strategy is mean reversion, where traders expect the price to return to the middle band after hitting extreme levels. But remember, Bollinger Bands work best when combined with other indicators to confirm trade setups. There are countless indicators available, but we've covered some of the most commonly used ones in the markets. Indicators serve as tools to assist traders in their analysis, providing insights into trends, momentum, and potential trade opportunities. Some traders use them for confirmation, while others rely on them for entry and exit signals. However, no indicator is foolproof. It's all about how you integrate them into your strategy and use them alongside price action and risk management. Price action. Price action is the movement of an asset's price on a chart. It reflects market behavior, forming patterns and structures that indicate bullish or bearish sentiment. By studying historical price movements, traders can anticipate potential future trends. Price action is the core of technical analysis in all markets, forex, stocks, commodities, and more. It provides a clear view of market dynamics, helping traders identify opportunities. While some traders rely solely on price action, others combine it with indicators, support and resistance levels, and chart patterns to refine their strategies. In short, mastering price action is essential for traders looking to understand market trends and make well-informed decisions. Fundamental analysis. Fundamental analysis focuses on evaluating an asset's intrinsic value by examining its underlying factors. For stocks, this means analyzing financial statements, revenue, expenses, profits, cash flow, and key ratios like price per earnings, earning per share, and return on earnings to assess a company's health and growth potential. In forex trading, fundamental analysis looks at economic indicators such as GDP, interest rates, central bank policies, and inflation to predict currency movements. By understanding these fundamental factors, traders can make informed decisions and adjust their strategies based on market conditions. How to become good at trading and investing, and why is it not an easy road? Is it possible to achieve profitability and success in trading? Absolutely. The proof lies in the success of numerous proprietary trading firms and seasoned traders who consistently profit in the markets. But is it easy? Not at all. If it were, everyone would be a millionaire. Becoming a successful trader requires more than just knowledge. It demands discipline, patience, and relentless effort. Trading is a profession of trial and error where consistency and adaptability are key. You have to test strategies, analyze your results, and refine your approach. What works for one trader may not work for another, which is why experience and personal development play a crucial role. For me, the journey was long and challenging. It took years of studying, testing, and refining my strategies. I tracked every trade, kept detailed journals, and spent countless hours backtesting to understand what truly worked. There were frustrating moments, times I felt like giving up. But I pushed through, celebrated small wins, and stayed committed to the process. Eventually, after persistent effort and self-discipline, I moved past the break-even point and achieved consistent profitability. And that's the key. Trading isn't about quick success or luck. It's about discipline, resilience, and the ability to learn from both wins and losses. So, if you're serious about trading, be prepared for the journey. Stay disciplined, refine your strategies, and remain patient. Because with the right mindset and commitment, success is within reach. It's not an easy road, and anyone who tells you otherwise is lying. If trading were easy, everyone would be doing it, and everyone would be successful. But the reality is, most traders fail because they underestimate the difficulty of the markets. Success in trading requires discipline, patience, and an unwavering commitment to learning. It's a skill that must be developed over time through experience, trial and error, and continuous self-improvement. There will be challenges, setbacks, and moments of doubt. But those who push through, refine their strategies, and stay consistent are the ones who achieve long-term profitability. So, if you're in this for quick money, trading isn't for you. But if you're willing to put in the work, stay disciplined, and treat trading as a profession, success is absolutely possible. This concludes the introduction section, your first step into the world of trading. We've covered key concepts that lay the foundation for your journey, touching on various aspects of technical analysis and trader development. This course is designed to enhance your overall trading skills rather than focusing on a specific asset. Different markets react slightly differently to various tools, and it's through experience and self-improvement that you'll learn to adapt and refine your strategy. With time, patience, and practice, you'll start identifying high-probability trades more consistently. If you have any questions, feel free to use the question box. I'll be more than happy to help. I hope you're enjoying the course so far and making the most of this knowledge, which comes from years of trial and error. Big thanks for being here, and keep going. Your success in trading is built one step at a time.